good morning and good afternoon, everyone. I'm here with Chris Neumann, who is a partner at Panache Ventures. Thanks for being with me here today.
Thanks for having me.
So, Chris, we're going to talk today about crypto or Web3 project viability. Before we get into that, I'd just love to hear a little bit of your background in the Web3 space and maybe even going back more generally into this VC space.
Sure. So my very quick background, I'm an engineer by trade, so have a master's degree in computer science. That's where I grew up. Was a software engineer for a number of years, and then got involved in startups in the data analytics space. So spent most of my operator career doing database software, BI software, that's business intelligence software, understanding how to make sense of large volumes of data.
Yeah.
After my last startup was acquired, I started moving over to the investment side and spent years at an accelerator in San Francisco helping to coach founders before coming back to Canada, joining Panache as a partner where we invest across all segments. So our fund is the leading pre-seed fund, which is another way of saying the first stage of capital that gets invested into companies. We invest coast to coast from Victoria to St. John's, and we invest in most areas that involve technology. So we're a technology investor. We invest in software companies, we invest in AI companies, we invest in all sorts of other things, including Web3 at that very early stage.
That's great. So you're taking on some of the highest risk projects out there. Am I right in thinking that?
Exactly. So pre-seed investors are typically the first, what we call institutional investors in a company. When you start your company, you might bootstrap it or fund it using your own money. Maybe it's a few of you in your dorm room trying to get together a first prototype. The initial capital that you raise is often what we call a friends and family round, where you'll go out and talk to people you know, maybe people you worked with in the past, get a little money in there. Once you've made further progress and you need a larger sum of capital, you start reaching out to VCs.
Yeah.
So pre-seed VCs, we're usually the first ones there when there may or may not be customers, there may or may not be a fully functioning product,
Right.
but we're taking that risk and helping you hit the milestones you need to start your journey progressing along to larger sums of capital and hopefully greater global success.
Okay, that's great. I like that. That's a good summary. Okay, so when you're looking at, let's talk about specifically Web3 projects or crypto projects. When you're looking at some of these projects that are presented to you, how do you assess the viability of a project?
Sure. Well, I think it's helpful to separate what we mean by project into a couple of different categories. And if we talk about Web3 more broadly, many projects are what you could consider a one-off attempt to build something, right? Maybe you're building IP, maybe you're building a brand, maybe you're building a very specific type of functionality. And the other type of company in Web3 are companies that are building infrastructure, right? So we're building tools for others to use to build their Web3 project. So if you think about folks here in Vancouver, we could think about someone like Dapper Labs or someone like Manifold. These are companies that are building infrastructure that others can use to create Web3 products.
Right.
We think about something like Doodles, right? Doodles is a project built on top of this infrastructure. I tend to think of it like media, right? If you think about big film studios or companies that are building recording equipment, all the equipment that we're using here to do this podcast, versus somebody who's creating a particular film or even an entire universe like the MCU.
Yeah. Okay, that's great. I think that's helpful as well for people who want to buy crypto tokens, that they realize, or we realize, that we are buying into companies that are offering some type of product or service. This isn't just because I think sometimes the term cryptocurrency is a little bit confusing. A lot of these are not currencies and have no intention of ever being currencies. They are, simply the tokenization of an existing company or a future company, I guess, in some cases. Am I right about that?
Yeah, I think that's a great way of putting it. And to take it a step further, I think we actually have a language problem in this broader crypto and Web3 world right now, where some of the terminology immediately evokes preconceived notions about what that thing is. So we'll talk about cryptocurrency. The word currency is literally in that term, but yet we use that and we apply it to things that are not meant to be utilized in that way. And I think there's probably some evolution that needs to be done there.
Sure. Yeah. And I think, sometimes when we think, well, yeah, maybe Bitcoin is or will be a currency, but maybe there's 20,000 other cryptos out there or tokens, and certainly almost all of them are not ever going to be and never intended to be currencies. And so it is a bit of a confusing term. So when we look at project viability, you're investing into a project before most people even know that it exists. When you're looking at a project, how important is the founding team versus the product that they're actually trying to create?
So from a VC standpoint, and I'm talking about as an institutional investor, which is a little different from an individual investing in a particular project. As a VC, we're investing for a long horizon. And so whether we're investing in something in the Web3 space, whether we're investing in, database software or drug discovery or whatever the case may be, we're investing in the beginnings of what we hope will be a company that will last 7, 10 years or more.
Mm-hmm.
So we are investing first and foremost in the team. And in fact, we're assuming that whatever stage they've made, let's say they've been working on this project for a year,
Mm-hmm.
right? They're still incredibly early in the journey, and they're likely to have to make some very hard pivots. They're going to
Right.
find out along the way that they've made some assumptions that are correct, and they've made some assumptions that are wrong, maybe about the market or the competition or, whatever the case may be. So for us, it's crucial to have conviction around the founding team and their ability to build something and adjust to changes in information, right? We're investing based on imperfect information, and they're creating a company based on imperfect information.
Yeah. Okay, that's interesting. And so the team is really what you're looking at here. So if we kind of put this project maybe a couple of years into the future, maybe when they've tokenized the product and now they are trading on an exchange or something like that, how important do you think the crypto investor, the retail investor, how important is the team at that point when, I'm going to go and buy this token on some kind of decentralized exchange?
When evaluating from a retail perspective, you're usually going to evaluate much more based on objective evidence,
Mm-hmm.
right? So at the point that, they've made 3, 4 years of progress, maybe there's a token out there, you can look at the numbers and you can start evaluating what's going on with that token,
Yeah.
right? How much is being transacted every day? What are the metrics around whatever the utilization is if it's a utility token?
Yeah.
You also conversely probably aren't going to have the opportunity to meet the founders personally,
Right.
right? So anything you learn about the founders is likely to be through a third party,
Mm-hmm.
be it the media, be it somebody else, right? So you actually kind of have to take it with a bit of a grain of salt.
Yeah.
You might be seeing a persona which may or may not reflect who that person actually is.
Uh-huh.
On the flip side, when we're looking at founders, right, we're doing reference checks just like you would for a job interview. So we're calling people up, we're reaching out, we're learning about those individuals as people, and we're really diligencing them just like you would any other collection of individuals.
Yeah. So, as a retail investor, we don't have the luxury to do that. In fact, many times in projects in Web3, you don't know who these investors are. They just have some type of pixelated image, and trying to figure out who that person is. And in recent months or years, we've seen huge projects collapse, and we don't even really know who these individuals are that started them, which is kind of scary, is it not?
It is, and I think it's also lessons that come with any new market, right? What happened in sort of the recent years of Web3 mirrors the kind of gold rush that we see anytime a new market comes in, right? Something's created, people look at it, they see some others getting rich, they rush in, they maybe jump in and start making investments without doing real proper diligence.
Yeah.
And it turns out that, hey, a few of these things actually weren't creating long-term sustainable businesses.
Yeah.
Then things collapse. Unfortunately, some people will lose their money. And as things resurface, we get better diligence and we start looking at it and going, okay, let's take a little bit of that FOMO out of it and let's start looking at this a little bit more seriously.
So when you're investing in projects and Web3 projects, maybe specifically, what is your hope of success? Are you hoping 1 in 10 goes gangbusters? Are you hoping 3 are relatively successful? What type of success are you hoping for on the projects you invest in?
When we invest, we have a lot of data around the success of tech companies in general, right? So Web3 specifically is still fairly young, but we have literally decades and decades and decades of data across the world around the success rate of startups. And so we know that relatively few companies ever get funding, right? To begin with. Once we look at the pre-seed stage, which is the stage where we enter, historically, companies that have some pre-seed investor, right? So somebody's done diligence and they have a reasonable track record, upwards of 90% of those companies will fail, right? In many cases, much higher. Typically, somewhere between 1% to 2% of those companies become very large success stories. And sort of the rest becomes something in the middle.
Yeah.
So we're investing using what's called a power law, which basically says our returns, the money we make, is going to predominantly be generated by a very, very small number of companies. So when we meet founders and we invest in these startups, we invest with a viewpoint that there is a potential future where this company will be absolutely massive, but there's a likely future when it fails for all manner of reasons, right? It can fail for business reasons. The founders can make the wrong decision. Competition can come in. The macroeconomy can change. And they also fail for life reasons, right? The founders just suddenly decide they don't like each other, or somebody becomes sick, or somebody quits, or whatever the case may be. So there's all manner of reasons, some inside our control, the vast majority outside of our control, which will cause a company to fail, right? So starting any project, any business is not statistically likely to be successful.
Boy, it must be so discouraging sometimes. Okay, so let's talk about white papers. Can you tell us what a white paper is, and maybe even tell us, when you're starting to invest, do white papers exist, and at what stage of the journey do they come into play?
Sure. So a white paper is a fancy crypto version of saying a business plan.
Right.
I have no idea why people in crypto decided to call them white papers instead of business plans. Maybe it was just some counterculture thing, but that's really all it is, right? In some cases, a white paper is actually very similar to an academic paper. So if we're talking about, really core infrastructure or cryptocurrencies, we can see very detailed, very, very complex academic level papers. But on the other hand, a lot of them are frankly half-assed blogs, right?
They're like written, you read them and you're like, did a high school student write this?
Yeah, like I've seen people who said, hey, here's our white paper, and it's just a Notion page with like 5% of what I would want to see on there.
Right, yeah.
Right? Or, some of these play to earn projects or Web3 games where they're like, here's our white paper, and it's like version 0.01 of like the instruction manual. Right? So, I don't think that there's a definition of what a white paper is today.
But I guess we see like Satoshi's paper on Bitcoin. It very much feels like an academic paper. Like it looks like an academic journal paper, which is quite different than, like, I don't know, some play to earn video game that's never going to come into existence.
Totally. And I think that's what we saw with the rush of capital and sort of the FOMOing in and the eagerness to jump in, is we started with like a white paper is really an academic level paper. And then it went down and went down and went down. And investor money was throwing in. And then it was basically like, look, I launched a Notion page and I put a title on it. Will you fund my project? Cool.
Okay. So when you're investing in projects, do white papers exist? And at what stage do they come in?
For a VC to invest in any company, there needs to be one of, let's call it, three things, right? There needs to either be a product in a business that exists, where it's like, okay, we've built this, here it is, here's some customer case studies or user data or anything like that. The second version is a fairly detailed, we'll call it a business plan, right? But it could be in a variety of formats. It could be a slide deck. It could be a Notion page. It could be something else saying, hey, here's what we intend to build. Ideally along with a prototype or something showing that the team is capable. In the very rare case, you will see companies fundraise purely based on the team, where it's basically like, hey, here I am, I'm awesome, give me money. Those are incredibly rare, and they're usually repeat founders, right? So, if the founder of Ethereum suddenly showed up on a VC's door and said, hey, I'm starting a new company, they would say, cool, we don't care what you're doing, take our money, right? But for most of us mere mortals, that's not the case.
Okay, so when you look at, let's say, from the perspective of a retail investor, when we look at white papers, how do we look at them? So they're business plans. What is interesting or important in a business plan from an investor's perspective, and what are some things here that would be like, I don't know about that? Like, what red flags do you look for when you're investing into projects?
Sure. So when I'm looking at a project, I want to understand, does the founding team have a clear vision for what they want to create? have they identified a problem or a need that is specific and that they believe they have a solution for?
Right.
Right. So if somebody comes to me with a white paper and says, we're going to create a play to earn game about wizards, right? That doesn't tell me a lot.
Yeah.
Right? Who's going to be interested in this? Who's going
Yeah.
to buy it? Does one already exist? Why is yours different? Why is yours special? Why does it have to be on the blockchain? And so on and so forth.
Yeah.
On the other hand, if someone comes in and says, hey, look, here's a really specific problem, right? So as an example, in the music industry, there are labels and there are singers and there are publishers and there are radio stations, and none of them know what the royalties are, or none of them agree on the royalties for figuring out who owes whom money. So I'm going to build a solution on the blockchain to do this. This is how I'm going to do it, right? That is a company that's identified a specific need, and they've also given a reason why they need to use the technology that they're using.
Right. Okay, that's great. I like that. Now, sometimes we hear sayings like, don't invest in anything you don't understand. Now, I would argue that most people investing in Web3 as retail investors don't understand what they're investing in, because some of it's very complicated and technical, and most people aren't technical. So how do you find the balance? Do you ever invest in something you don't fully understand, that you understand in? And where do you see the line here as like, okay, I kind of get it. I get the concept, but I don't understand the technical aspects of it. I'm going to invest in that.
So there's a lot to unpack there. First off, I would say that I actually don't think it is necessary to distinguish between retail Web3 investors and just retail investors for the question you're asking. There are a lot of people who buy stocks without really understanding what the business is, right? Wow, I like such and such a clothing brand, therefore I'm going to buy their stock, right? Now, there's a lot of sort of nuance into talking about that, but is that a good investment decision? Well, on one hand, you could say, well, I like this clothing. A lot of my friends like this clothing, so I think this brand is going to go in the right direction. I think it's a good investment. But you could also say, look, I understand absolutely nothing about their margins, their metrics. Is this company growing? Does this make sense? And so broadly, good financial advice is if you don't understand something, you should probably invest in an index fund, or you should invest in something that spreads that risk around. But that's not to say that you also shouldn't, take some risks as an individual. I'm not here to answer financial advice, answer financial advice, provide financial advice. Please consult your financial advisor. But I would say if you don't really understand a project, and the only reason that you're going into it is because you saw people on the internet saying it's a cool project and you should get in now, that's probably a very bad financial move.
Okay. Yeah, that's good. Okay, I want to kind of wrap up our conversation with one remaining topic, a topic around tokenomics, and maybe understanding vesting schedules and what that actually means. So can you maybe explain to us tokenomics and what that is, and where does the VC come in and where does the retail investor come in?
Sure. So in Web3, a lot of the functionality we're seeing now is based off of a token entity, right? That could be a token that's used in terms of access to something. If you have this token, you can get certain rights, you can get certain privileges, you can get a discount on a t-shirt. It could be something where there's an earning potential or an economic model around it. So the tokenomics describe how does this token operate in an economic world? What is it intended to do? How are transactions intended to be made? Understanding the tokenomics is really important to understanding your expectations of what this token is and could be worth in the future. In many cases, there are projects that came out that were play to earn projects where if you looked at the mathematical model underpinning the tokenomics, it was effectively a Ponzi scheme. There was no way for this to actually sustainably generate value. In other cases, we see things that make sense. We see things that are long-term sustainable. And so understanding that is quite important, whether you're a professional investor or a retail investor. As it relates to VCs, there's two things that are important to think about. Number one is whether or not a VC is even able to hold a token. And this is something a lot of people don't realize. Most VC firms in their what we call limited partner agreement, which is effectively our shareholder agreement, most VCs do not have the right to hold tokens.
Mm.
And so our investment documents will basically say something like, we will exchange money for shares in a company or convertible debt in a company, but those are the types of things we can hold. And so this idea of tokens is you're seeing a lot of funds that just actually can't invest or even hold them. The reaction to that in many cases was that funds would create dedicated crypto funds. And so the reason why you saw a lot of very big name VCs launch specific crypto funds was partially because they wanted to go after that in a very focused way, but partially because their main funds actually can't invest in crypto.
Right.
And so that's part one. In the case of Panache, our newest fund has the ability to invest in tokens. So we can invest in tokens, we can receive them should any of our companies generate them. Now, a vesting schedule refers to how long do you have to hold the token before you can sell it? Or sort of an inverse way of thinking about it is, how long do you have to be involved in a project before you earn the right to sell the token? If you have a job, if you work for a startup, you'll often get something called options, which is the ability to purchase shares in that startup. And the ability to do that is based on working at the startup for a certain amount of time. If you work there for 4 years, you get this many shares. Tokenomics have the equivalent, right? Which is, okay, you get these tokens, you are allowed to sell them on or after such and such a date.
Okay. And then, when we look at the retail investor, sometimes you look at these vesting schedules and you see, okay, at this date, the VCs can sell their tokens. And we see a big drop in price at that time because they do take that opportunity to cash out and limit their exposure on that investment. And it's important for the retail investor to know that, because this may be a time to buy shortly after, because maybe you see a dip, or maybe you want to offload before the VCs have the opportunity. My question to you is there any other reason for VCs to sell a significant amount of tokens at that date other than just reducing their exposure or taking their profits?
That's a really good question. So different VCs have different investment strategies. And going back to my comment on the LPA, the limited partner agreement, for most VCs, our investment strategy is actually built into that. So when people invest in our fund, we give them a prospectus that says, this is how we are going to invest. In some cases, the fund actually contractually needs to sell, whether it's shares, whether it's tokens, at the earliest possible opportunity, because that's what they've promised their investors.
And that could be 100% of them?
That could be 100% of them. In other cases, the management team has the right to make those decisions. Now, in traditional investing, where we're investing in shares, right, the equivalent is when a company IPOs, there's a lockup period where the original investors cannot sell for example, 90 days after the IPO, right? At the end of that 90 days, you will see some investors offload 100% of their shares. You will see other investors who sell a small portion. Other investors will hold. That is typically a reaction to their investment policy.
Right.
Unfortunately, as a retail investor, you have no idea what the investment policies of the various investors are. Right. And even more so in cases where in the crypto world, we might not actually know the identities of some of those investors, which makes it even harder.
So the VC is not responsible to make this public, this information. This information is only available to those who have invested into that fund. Is that correct?
Which information are you referring to?
The information as to what their policy is around when they have to sell and how much they can sell.
Correct. That said, in the US at least, there's a little more structure around this because of regulations imposed by the SEC. And so in the US, there are many funds that simply are not able to hold public share positions. And so there we tend to see a lot more predictability, which is effectively, in many cases, the companies will offload, the investors will offload at the earliest possible opportunity so as to return capital to their shareholders.
Okay, that's great. That's super interesting. I think that's really helpful to understand the vesting schedule, especially if we move into a time in Web3 where ICOs and IDOs are a big deal, and we see people raising funds. Understand kind of the fundamentals behind the scenes, because it's hard for the retail investor to understand what the VCs are doing and what's happening in their minds. But understanding that to some depth, can be really helpful.
Yeah, and I would add one other thing, which is there's a gap between this behavior as it relates to public markets and crypto markets and Web3, in that public market investors, whether retail or professional, are by and large significantly more sophisticated,
Hmm.
and there's a lot more experience around that. And so what you don't tend to see is when a company IPOs and that lockup period ends 90 days later. When the company IPOs, they have to publish all of the lockup periods. So the
Right.
market can actually bake into the pricing
Right.
expectations around what will happen in 90 days. And so
Yeah.
we don't tend to see massive, changes,
Right.
with a few exceptions, right? So if say, let's say there's a public company where the founders of that company and the CEO own very large percentages of the company, and in one day everyone who works at the company like sells their shares, that's usually a really, really, really bad sign, right?
Yeah.
In the crypto world, we don't know a lot about that, and many of the people who are investing in crypto projects don't even realize these things exist.
Yeah.
And so we do have definitely an information imbalance
Yeah.
relative to more mature markets that exist in the financial world.
That's really good. I like that. Okay, I think we'll leave things there. That's super helpful. I love understanding vesting schedules and how that impacts, retail investors. Getting a sense of, where VCs are coming from and what they're looking at and how you're analyzing project is really helpful. Chris, I really appreciate you being with me here today. That was excellent.
Thank you so much for having me, and good luck everyone in your Web3 adventures.
Thank you.